My name is Ed Gilmer. I'm the Director of Capital Markets with PassiveInvesting.com. I handle our multifamily loans and a lot of loans for other asset classes as well. I watch a lot of the stats, the forward curves, the Fed funds rate. I watch a lot of the stuff on a daily basis. It really helps to be plugged into this so you can make sure your pro formas are right, your budgets are right for any properties you currently have. You can underwrite future properties. So we're going to kind of dive into some of the numbers I watch, look at the markets right now, and kind of see where things are going. If you have any questions, feel free to drop them in the chat or raise your hand. I'd be happy to address them as we talk today. I'd like to have this as conversational as possible. Numbers can get kind of boring, but especially when they're pretty high like they are. So feel free to raise your hand or ask a question. I'm going to go ahead and share my screen here. All right, this is a website called CME Group. You can just Google Fed Outlook, a Fed Funds Outlook. This is where the Fed officials vote 8 times a year on rates. And real quick, and this kind of determines prime rate, Fed funds rate, prime rate. Wall Street Journal prime is about 850, so 300 basis points over this. So real quick, the next meeting is 11/1, and this has the probabilities of the rates. We're currently at 525, 550, right? So these rates would be staying flat right here. So for about the next 5 months, the rates are expected to be flat. And one caveat, the further out we get, the less likely this is to be accurate. You can see the percentages are kind of spread around, more so the further out. This is a survey of Fed governors and their predictions. So the next meeting is in 7 or 8 days. Pretty sure that one's going to stay flat. The last meeting of the year would be December, and they expect rates to stay flat there as well. About 30% expect a quarter-point rate hike. I doubt that's going to happen in my opinion, but these people are probably much smarter than I am. So, and then the first 3 meetings next year, end of January, mid-March, and early May, you're kind of a toss-up. Likely going to stay flat. Could go down, could go up. Once you get into June, and this is what we're going to focus on today, the second half of 24, a lot of people are really expecting rates to start to come down then. This is going to affect treasuries, SOFR, prime rate, deposit rates, bank, everything. So it's about split between a reduction and staying even in June of next year. July tends to trend downward. September, November, and December, you're going to, hopefully this is right, and we're going to be 75 basis points lower at the end of next year, maybe even more depending on how the economy works out. So this is kind of a summary down here. Basically, we won't be where we are today forever. After June of next year, pretty sure we're going to have lower rates according to this site. So let me minimize this one. We can go back over this in a minute as well. This is the SOFR forward curve, SOFR. A lot of multifamily loans are based on SOFR plus a spread. We've been over this a few times on previous webinars. They tend to be SOFR plus 300 basis points, 350, 400 basis points. And the column we're looking at here is the 1-month term SOFR. Right, it's been about 530, 531, 532 for a few months now. They kind of have it trending upwards the next couple of months. This has been pushed out. I think this is assuming there's going to be a rate hike again. So I don't think this is going to work out. It's probably going to stay about 530 the next couple of months, in my opinion. But what the trend I'm seeing here is, again, after middle of next year, you're seeing a pretty steep drop off into the second half of next year, going from 520 down to like 462. So 60 basis points. Like the Fed watch, the further out you get, the less accurate it's going to be. So, I mean, this thing goes down to 2020, 2030. So I think once you get into the second half of next year, definitely expect some lower rates here. And then looking forward to 25, maybe a couple more cuts. I wouldn't put much weight on this thing past 12 months, but hopefully it ends up lower than this. So there's that one. And then one more I wanted to reference. We can kind of go back through these with questions. Let's see here. It is not this one. Let's see. Here we go. This is the projected odds of a recession based on a pretty broad market survey. Earlier in the year, a lot of talk about recession. A lot of economists have started to predict that's not going to happen. It's going to be quote unquote a soft landing. So if you keep hearing those terms, soft landing, that's what that means. Probably not a recession, maybe some softening in the economy. We're currently right here, September, October. So they're starting to predict higher odds of a recession going into next year. I think we're going to have some headwinds for sure the first half of next year. And then my question is, what do we do about this, right? Take all this data. Data's great. What do you do about this data? Feel free to jump in with questions on chat. So with the, I guess Stephen has a question. Let me answer this first. How is SOFR calculated? Term SOFR is a forward average. There's also called a 30-day SOFR. That's a backwards average. It's so LIBOR was a survey type rate, and how SOFR is calculated. That's a good question. I don't know the answer. I know this website tells me. The website's called Pinsford, so I might need to do a little more digging in that. That's a good question there. Sorry, I don't have a better answer for you, but it is published daily, and I'll watch the forward curve often to see where they're predicting it to go and where it does go. So, but what do we do with this data? I think you can use this if you have any floating rate deals. You can strategize buying rate caps. Is it smarter to buy a rate cap now? Is it smarter to buy a rate cap further out? A year ago, rate caps were pretty pricey, but that same rate cap today would be much pricier based on the higher for longer predictions and all these rates. So for the Fed funds, treasuries, all this, all your agency deals are based off of treasuries, 3-year, 5-year, 7-year, 10-year. As many of y'all know, those have just exploded the last couple of months, especially the last few weeks. So if you were looking to do a fixed rate agency deal, the higher rates are going to reduce your proceeds on those a lot. I'd be surprised if anybody's doing any agency fixed rate deals right now, unless your plan is, a 7 or 10-year hold. If you sell early on an agency deal, you're going to have some pretty serious prepayment penalties on those. Let's see. Guillermo says, the positions of debt now for investments made in the last 2 to 3 years. Sure, good question. Kind of market-wise, the majority of purchases the last couple of years have been bridge debt. Those have come with either 2 or 3 year initial terms. So a lot of those sponsors are coming up on their extensions. Some extensions can be interest only, or they can be amortizing. What we're starting to see is some folks work with their lenders to modify the extensions. If you had an amortizing extension initially, maybe you go back to them and say, hey, rates are crazy. Nobody ever predicted rates this high. Let's rework this thing. It's good for us, good for you, to try to get some more term of interest only, reducing your out-of-pocket every month. So you're coming up on rate extensions, rate cap extensions. Some of these will have debt yield hurdles or DSC hurdles. So debt yield is NOI over loan amount, and DSC is NOI over debt payment. So there may be some challenges hitting those hurdles with lenders as well. My advice is try to work with your lender, see if they can modify terms to make the goals achievable. Nobody wants to have loans that don't perform. Then the lender would have to foreclose on them. That's not good for anybody. Lenders want to avoid that at all costs. So if you have a deal where the cash flow is tight, you're coming up on an extension and it has some DSC or debt yield hurdles or loan to value hurdles, work with your lender. I've seen a lot of brokers and lenders starting to be more open to that than they have historically. And I think that's going to be good for operators. Keep some cash in your pocket. Like you saw in the numbers, there's going to be some challenges the next 6-12 months or so, at least, with rates, and having a loan or more term, more interest only term would be beneficial for the sponsors. Give you some more room to execute your business plan. Hopefully save some cash, reserve some cash for the next rate cap purchase. A lot of wins there. So my advice, what you can do with the SOFR curve, it tends to historically predict rates higher than they end up being. So you can Google SOFR forward curve versus actual and find a chart that has the forward curve always has it doing this. It's higher, higher, higher. It tends to be optimistic on how high rates are going to be. Likely they're going to be lower. So hopefully that chart I showed you of the SOFR forward curve, they come in lower. That all this directly affects rate cap pricing. There's a website called Chatham we use to price out rate caps. We use multiple services, but that one's pretty easy. You plug in your dollar amount or the notional, the SOFR cap at 2%, 2.5%, 3%, and the term, 1 year, 2 years, 3 years, and it gives you a ballpark price of what that rate cap would cost today. That could change daily between now and when you have to buy one, especially with the Fed meeting at the end of this month. If they do come up and don't raise rates and they say they're not going to raise rates anymore, they've already alluded to that in some of their pieces they've put out the past week or so. But if they keep this a narrative of not raising rates anymore, I think we're going to see some relief on rate cap prices going forward. Much needed relief. One of the rate caps we bought a couple of years ago was like 100,000 at purchase, and that was a 3-year rate cap. That same one today for a 1 year is well over $1 million. So there's some serious cost here. And if you have a multifamily deal, a floating rate deal with no rate cap, I would suggest looking into that to limit your exposure. If you've been reading some of the headlines recently, some of these sponsors that have had deals foreclosed on haven't had rate caps. So they've been getting hit with this interest rate run up and draining the cash flow. These deals were historically SOFR plus 300, SOFR plus 350. SOFR was 0.05%, 0.5% for years. So a lot of people just assume rates were going to stay low forever, underwrote 3%, 3.5% all in, and now SOFR plus 3% is 8.32%. So unless you have a rate cap to limit your exposure on the high end of SOFR, you're getting slammed on interest. Lenders are doing pretty well. So, but sponsors highly recommend, I can't say it enough, you have to have a rate cap for a floating rate deal, bridge deal, not agency. Agencies require them as well, I believe, but they require escrows. Every few months, they'll check your escrows to make sure you're reserving enough money for the next rate cap purchase. Guillermo asked, do we have caps in all the loans contracted? Are you asking about the loans that we have, Passive has, or what loans are you specifically asking about, Guillermo? Yeah. Yes, 100%. That's on bridge deals. Bridge lenders require rate caps. I don't understand how some of these folks that have had foreclosures, who gives them the money and doesn't require a cap? That's just poor business. We have one to protect our own interest, two because lenders require it. And a lot of these caps, most of them are SOFR 2% or 2.5%. We have a couple a little above that, but those have been paying out significantly to offset the increased interest cost monthly for years. SOFR was never predicted to be where it is now. So highly recommend those. Some other things, we're always looking at what makes the most sense for each asset. My job will be a lot easier if all of our deals were switched into agency fixed rate loans. But right now, you're looking at a 5, 7, or 10-year loan in the 7% range. Just take the Treasury, and they had a spread of 180 to 200, 220 basis points, perhaps lower on some deals. But I mean, that's in the 7% range, fixed for term for 5 years, 7 years, 10 years. That's a long time at a pretty high rate. Obviously, what we saw, most everyone predicts rates to be lower in the future. So when you have a fixed rate loan at 7%, for 10 years, and then rates drop, that loan next year or the year after could be 5.5%. And if you did go to sell it, you're going to get those prepaid penalties are based on your rate where market rates are. The lower market rates are, the bigger the spread between your loan rate and market rates, the higher prepay you'd have. So I don't know how a fixed rate agency loan would work right now unless you plan to hold it for 10 years and you're not concerned with interest cost. So any questions on multifamily rates? All right, the other thing I wanted to talk about was what to do going forward. On all the deals we're looking at right now, we look at multiple deals per week across the Southeast and the Sun Belt. And I told our acquisitions team last week, I was like, we just need to stop looking at agency financing on these deals. Only look at bridge debt. Like I said, I would prefer fixed rate. It's just idea is better, but rates are terrible. So we're looking at 2 to 3 year bridge terms with rate caps until rates come down. So the idea there is you get 2 or 3 years of interest only, perhaps more, to get past the next 24 or 36 months of inflated rates. And at that time, the property will have better cash flow. You'd be more properly structured for an agency refi at a lower rate. So I think the big picture is long-term, we're looking to, or anybody, I think the goal of multifamily, if you're gonna have a property more than a couple of years, you want to switch to an agency fixed rate deal. It's historically lowest rates. So that's the plan, lowest cost. Hopefully rates come down the second half of next year and into 2025. And I think you're going to see a lot more operators switch into agency fixed rate loans. Let's see. Jalen says, if you pay interest only, why not just buy down the rate if you're holding long term? Agency buy downs, they have limits. So you can only, the longer the term, the more you can buy it down. Basically on a 10-year agency deal, you can buy it down up to, it's called 35 basis points or so. That's like 1.5, 2 points up front. But that's going from a 7% rate or so to 6.65% rate. The payback on that is diminishing once you get past the 12-month, buying it down more than 1 point. So on a 10-year, 1 point buy down is about 18 to 25 basis points. I think you can go up to 30, 34, 35, I believe. But I think after that, it's just a diminishing returns. You're paying more for less reduction of rate. It definitely helps. We're looking at that. We were looking at that up until we stopped looking at agency deals. But like I said, I'm always a proponent of looking at all your options, all your debt options on any deal. So when looking at agency deals, do factor in rate buy downs. Historically, they were not much of a factor because rates were pretty low forever. But right now, with rates being higher, that is a tool you can use to get, marginally lower interest rates. So we have seen some success with other operators. We doing rate buy downs. Some of the debt brokers I talk to on a weekly basis are doing a lot of those. It's a few more bucks up front, but it's lower rates for a longer period of time. The payback on those is about 3 to 4 years. Last time I looked at it. So if you're planning to hold it more than 3 or 4 years, I think a buy down would make sense. Any other questions on rate caps, SOFR, bridge debt, agency deals, any multifamily debt questions, or any of y'all buying any deals right now? And if you are, what kind of debt are you looking at? So drop that in the chat for me. Be curious to see what other operators are looking at on debt here. So, all right, Frenchie says, please explain agency deals. Agency, so it's like your Freddie Mac, Fannie Mae deals. Those are typically fixed rate, long-term financing for multifamily assets. Kind of like a mortgage. They're kind of like a residential mortgage. They're very strict guidelines. They underwrite DSC based. You have to have a 125 DSC on a 30-year amortizing rate. Sometimes they extend that to 35 years to get you a little more proceeds, but those are what we call DSC constrained. I mean, if your property produces, let's say $100,000 of NOI per month, and it has to have a 125 coverage. Let me back up. If it produces $125,000 of NOI per month, and you need a 1.25 agency coverage, they're going to size up your debt based on $100,000 per month of debt payments. And the higher rates go, the lower the proceeds get. If you're pricing out debt on 4 or 5%, that $100,000 per month can get you a lot more dollars. If you're pricing out debt at 6.5%, 7%, that $100,000 of debt payments gets you a lot less dollars. So kind of to simplify it, that's where we are with rates being higher for so long. Proceeds are getting pinched on purchases and refis. So a lot of the debt brokers we work with on a daily basis the business is slower right now for sure. So let's see here. All right. Any more questions I can answer? I would love to see, are some of the participants today, do you have any deals on a contract? What are you looking at for refis? What's working for you? What's not working for you? Anything else we can answer here before we wrap this up today? I'll give it a few more seconds here. All right, well, to sum it up, I'm hopeful rates go down faster than these charts show. I think with a couple good months of some economic data, I think March, April, May of next year, we're going to start to have some reductions from the Fed. SOFR is going to drop off, which is in turn going to lower rate cap cost, which is good for everybody. I think hopefully if 2024 slows down but doesn't have a recession, I think 25 is going to be back to like a normal year. A lot of activity. A lot of the conferences we went to early this year said that the second half of this year would be a good time to buy. There was more deals coming online. We're starting to see more deal flow from the acquisition side. I think you're seeing seller expectations come down on pricing due to debt, insurance, etc. Carlos had a good time to buy. We're getting there. There's some deals we've seen that we offered. I'm going to say some ballpark numbers here. There was a deal. I think they were asking $315,000 per door 6 months ago, and we were probably in the 260, 270 per door range underwriting wise. That deal came back to us. They were then asking $285,000 door. They came back at like 265 a door, and we have since pulled back on our offers because of the rates. So there, but that answers the bridge question. And we're still, that deal that we're looking at agency debt 6 months ago, we're now sizing up for bridge debt at a lower cost per door. Guillermo says, are many potential deals to acquire go down due to financing right now? Financing is one of the biggest factors in underwriting. If you're looking at, if you get a SOFR plus 350 deal and you buy a 2% SOFR cap, that's a 5.5% debt, but probably a couple $1 million for the rate cap. If rates were 4% fixed with agencies, 3.5% fixed with agencies, like they were 3 or 4 years ago, there'd be a lot more deals going on. Let's see, Carlos, 1 to 2 price per door. What do you mean there? And the Guillermo asked, numbers don't make sense now. That might be in response. So with increased debt cost, it's a lower price per door that we can offer on the same property we're looking at 6 months ago at a higher price. So we're having to constantly update our underwriting on all these deals. And like I said, we're starting to see some deals come back to us. So let's see, Frenchie says, is this an opportunity due to rate triggers? I'm not familiar with the rate triggers. I don't think we have that affects any deals that I'm aware of or that I've heard of before. So if you want to elaborate on that, feel free to. Keith says, thoughts on HUD financing with adjustable downward rates? I like the idea of HUD. Conceptually, HUD underwrites to a lower DSC. They underwrite to like a 117 DSC on 35-year AM. So that can get you more proceeds. HUD takes 6 to 7 months to close a deal. And you can rate lock like after 2 months or something like that. So there's a lot of, you can rate lock between like month 2 and month 6. Where a rate's going to be in 2 months or 6 months, I don't know. Nobody knows. I think if the market was flatter, and comparing apples to apples, HUD, I tend to like better than the agencies, Freddie, Fannie, due to the lower DSC that they size to, and they typically do a 35-year AM. So you get more proceeds there. They just take forever to close. And then the longer you have to close, the more interest rate exposure you have up or down. So Frenchie says, is the private equity market benefiting due to higher rates? Somebody is. I don't know who it is. It's the lenders. I think the lenders are crushing it right now. If these bridge companies, these bridge debt guys borrowed money at 3 or 4%, and they're lending it out. They were lending at 5 or 6. Now that's 8.5%. They're crushing it right now. So Steven says, is there any concern of bank failure where you hold your funds? Is this anything you're doing to mitigate this issue? Thankfully, the last couple of bank failures have been bailed out by the government. They've kind of backstopped losses there. We do have multiple banking relationships, and we do watch deposits on a daily basis. Banking with reputable banks, highly rated banks is my suggestion there. I wouldn't bank with a smaller bank that has lower reserves and then potentially higher failure rates. So back to the chat here. With this new rate environment, delay the timelines as it exit pick current syndications. Any risk of not recovering at least original purchase price? I'd direct that question to IR, investor relations. I don't want to get into that on this webinar. So Carlos's question, 6 units, 1-1, how much per door, or 1-2? What do you mean 1-1, 1-2? Is that 1 bed, 1 bath, or what are you getting at there, Carlos? Are you looking at a 6-unit property? That's a broad question. Price per door depends on, is it class A? I'm guessing 6 units, unless it's brand new, you're probably a class B or class C. probably a 1980s, 1970s vintage. Okay, old. Depends on market. I mean, if it needs a lot of work, that can be anywhere from 50,000 to 150, 200,000 a door. Depends on market. I would find some market specific data to support your offers there. Some comps, look at some comps, what some other properties in the area have sold for. Talk with some brokers in the area and try to get some specific comps. I mean, a property in Columbia, South Carolina, and a property in Los Angeles, California, two different numbers. So I would talk to some local market experts and get some information there. We have a question in Q&A, and this is a good question. What is standard LTV nowadays? Good question there. Between 55 on the low end to 70 on the high end. The agency deals, you're going to be closer to 55 to 60% loan to value. That tends to be constrained by the amount of debt service the deal spins off. Bridge deals, you're going to be in the 60 to perhaps 70% range on the right deal in the right market. Bridge lenders like to be in the top 25 or top 50 metros in the US. If you have a deal in a small town for 50 units, you're probably going to get a higher spread and a lower LTV. If you have a deal in Charlotte, North Carolina, they like a lot. Raleigh, North Carolina, Charleston, a bigger metro, you're going to get a lower spread and possibly a higher LTV. I was quoted 70% LTV on a deal recently, brand new build, a lease up deal. So there's a lot of potential for growth there. But best case, I'd say 70. You're starting to get back to 70s. There was a time the last 6 to 12 months, so that was 65%. Nobody's going over 65%. So it's nice to see some lenders kind of getting back to the 70% range. A couple of years ago, that answer would have been 70 to 80%. I think 80% is high. I would 65 to 75 historically has been a good number. So it's nice to see the 65 to 70% deals kind of back online from debt brokers. So, and like I said, agency deals closer to 55 to 60%. So, well, I appreciate your time today. Thanks everyone for the great questions and interactions here. And look forward to seeing you next time. Have a good week.